Welcome, everyone. We are about to start today's webinar. I am Allison LaForgia, Managing Editor of the Content Studio at HousingWire. And today, our topic is social impact lending, lessons learned from the recent DOJ redlining settlements. And today's webinar is presented in partnership with NAMMBA. A few housekeeping items before we get into the juicy part of today's conversation. Today is an interactive webinar, which means you can submit questions at anytime using the Q&A icon at the bottom of your screen or by dropping your questions in the chat. Now, today's conversation will be led by NAMMBA's founder and CEO, Tony Thompson. Tony, the floor is yours.
Hey, thank you very much, Allison. We appreciate it. Let's see here. We have any music? Okay, my music is ready to go. I've already played that. But first and foremost, for those who I have not had the opportunity to meet, Tony Thompson, founder and CEO. Man, we're really excited about today's webinar. Really first of all, some great experts with me today to really help unpack the last couple of DOJ redlining settlements, and really most importantly, to talk to lenders and leaders about really how you could be proactive versus reactive when you think about looking at growing market share, looking at serving all aspects of your market. So we're really excited about today's webinar. And as Allison stated, we are going to have an interactive. So please send your questions. We're going to try to weave those in throughout the conversation, but also we've saved a little bit of time at the end. We've also made sure that anyone who is attending today's webinar will get a copy of this webinar as well. Last and least, we're going to jump into it. For those who have not or do not know about NAMMBA, man, I want to invite you to come to NAMMBA. Come to NAMMBA Connect, August the 20th through the 22nd in Orlando, Florida. It's the best experience. We call it the ultimate experience in our industry. So to learn more, just simply go to NAMMBA.org, but please save that date, and we would love to have you join us in Orlando, Florida in 2025. Well, let's get right into it, guys. I'm really excited to have two distinguished guests with me today, really sharing their expertise, their insights, their guidance as it relates to today's webinar topics. And so from that standpoint, I would like to introduce Laird Nusoli, who's the CEO of iEmergent, as well as Daniela Caceres, who is a partner with Mitchell Sandler. Laird, if you can, please share a little bit about you and iEmergent, and then Daniela about yourself and your firm.
Hey, Tony, and welcome everybody. Laird Nusoli, as Tony said, I'm the CEO of iEmergent, and our connection to this today is that, our firm, we do a combination of data, technology, and advisory services, but the real purpose of it is to help lenders, in a sense, grow their opportunity while closing the homeownership gap. So that's why we're a part of today's webinar.
Right, thank you.
Hi, everyone. I'm Daniela Caceres. I'm a partner at Mitchell Sandler, which is a mortgage regulatory law firm. We do other things as well, financial services boutique firm based out of DC, but I'm the head of the mortgage lending regulatory group. And so I work with lenders on everything from how do I structure my LO comp all the way through to enforcement and investigations. And that's what I'm excited to talk to you about here today, is just sort of that redlining enforcement, which we've been heavily involved with a number of lenders over the course of the last few years.
Sounds great. Well, first of all, again, Daniela and Laird, thank you guys for joining us. We're going to jump right into this, but since we do have an attorney on the line, let me just go ahead and give a disclaimer here. We are going to talk about cases that have been settled by the DOJ that were alleged as it relates to some of the concerns that the DOJ may have had versus the concerns of the lender. And so we just want to make sure everyone understands, we're not saying that this is bad, this is good. We're just here breaking this down. I like to say we're unpacking this, and we're just going to kind of say, what can you as a lender, what can you as a leader, if you're a compliance executive or marketing executive, what can you take away to apply to your business today? So first and foremost, why does this matter and why we're here? Every CEO that I talk to wants to do two things. They want to grow originations, and they want to also stay out of the headlines and mitigate their risk as it relates to from a regulatory review. And so we know that over the last year, actually 2 years, the Department of Justice, along with the CFPB, they've now have settled over $150 million of settlements as relates to their combating redlining initiative. At the end of the day, I'm an NAMMBA for life. I'm a mortgage banker. And, we never like to see any lender pay fines or money. And so our whole goal is to say, look, there's another way that we can take advantage of this opportunity to deploy capital. And we're going to talk about some of those best practices on how to do that. Secondly, why look at this market and why, certainly look at it from a business standpoint is real simple. The future of housing, in my opinion, based on all the studies that we do here at NAMMBA, 3 out of 4 loans originated last year came from what we call the multicultural market. So that is a large majority of every business in every community in every zip code. And then last but not least, we also believe here at NAMMBA that home ownership in every part of every community is a great thing for our communities, for our cities, as well as our country. And ultimately, at the end of the day, it helps consumers build and create and pass on generational wealth. So our goal today, as we stated, is just to go through and unpack and talk and share some insights, as well as have an interactive discussion, guys, as relates to opportunities for you and your organization to do good by doing good, as I like to say, but also an opportunity to take some of these key learnings and insights and certainly go back and apply those as best practices to your organization. Laird, why don't you take a moment to kind of walk us down memory lane a little bit here with the DOJ, and then let's talk about and just go through on a very high level the most recent DOJ settlements that we have thus far to review.
Tony, this slide, as we look at it, I'm not going to walk through each one of the pieces, but what I wanted to have show with this is that this isn't slowing down. If you look back to the 2015, there was a lot of work being done to, with redlining, and to prevent it and to, in a sense, from a compliance perspective, make sure that these things don't keep happening. But really, in 2021, when the initiative, the combating redlining initiative started, you can see the speed at which and the number, the increase in the number of lenders who, obviously there's been some enforcement action taken. And so that's what I think, just by looking at this timeline, you can see where we were looking at like 1 or 2 a year, fast forward to 2023 and 2024, in each one of these years, 5 or 6 institutions, were a part of one of these cases. So if you want to go to the next slide, Tony, we can kind of dig into those more recent ones. So one thing, as we look at the next 3 slides, I'm not going to spend a lot of time on each lender or in each slide, because I think if you have this deck later, you'll be able to read through this. But when we look at, what does it mean to, for redlining, where, what exactly happened? Well, we kind of can see that all of the cases fell into like one of 4 categories. You'll see that in each one of them, there was an issue with branch placement. So where an institution is located, which communities it's easily serving, that is something that's taken into consideration. Discriminatory marketing. Obviously, when we look at some of the actual details, there is significant disparity between the way these institutions connected with non-Hispanic white communities and communities of color. The next thing is, the failed sales governance. So what that means is, really looking at the sales and marketing strategies and looking at how well they are able to reach these different communities. That's obviously where there was another point of disparity. And then I think last but not least, and the one that's the most fascinating and surprising to me, is that most of these institutions knew about their risks. These are not cases that happen because of a time frame of a year. These are 3 and 4 years. And one of the things that the DOJ talks about in the complaints is that even though the institutions had knowledge of the disparate marketing and the challenges and knowledge that they weren't easily and properly serving some of these communities, they didn't address them. So these are the 4 content areas, and you'll see that in the next 3 slides.
Great.
Okay, so the first one we're going to talk about is, IMB. It's, Fairway, and I'm sure most of us have heard about, Fairway and the complaint about its lending behavior, or, how it's redlining in Birmingham. And really, we're looking at from 2018 to 2022. This is the time period that's really under question. Now, the first thing to look at here, and the most important thing, are those 2 charts. Both of them are showing a disparity in a different way. The chart on the right shows Fairway's percent of loans originated. So 37.8% of Fairway's loans these are in majority Black neighborhoods. Only 37% of those were to actually Black households, where you can see the peers, 74%. And the market in both of these really represents, what the census says is the actual distribution of households and, the race and ethnicity from a demographic standpoint. So in that case, 79% of the households in majority Black neighborhoods are Black. Fairway failed to serve half of those. Look at also on the left, and that's actually the chart I should have started with, that is their penetration of the Black majority neighborhoods. So what this is really saying is that 33% of the census tracts in Birmingham are Black majority. 3.7% of Fairway's apps came from Black majority census tracts. So that's a 33% to 30.7% difference. That's a very wide gap. You can see their peers were at 12.2. So this is important because this is even showing that even the peers aren't necessarily serving the Black majority neighborhoods in a fair way. And so if you want to go to the next slide. Similar thing with the Citadel, and this is the first credit union that's been a part of one of these complaints. And in this, you have that same chart where 5% of their applications came from majority Black and Hispanic census tracts, 13% of their peers, and then that market number, which is parity, 24% of the tracts. But if you look at the map here, you can see in a way visually what's happening. So the red and orange census tracts, and this is around the Citadel's market area, are some of the counties around Philadelphia, all the way over to Lancaster, Pennsylvania. So it's a kind of a unique multiple county area. And that's what you can see in that map. And the purple stars are their locations or their branches. And you can see that the red and the orange, those are the census tracts that are either majority Black, and that's the orange, or high majority Black and Hispanic, and that's the red. And that's where tracts where 80 to 100% of the households or the population are Black or Hispanic. The little purple dots are the actual purchase originations by Citadel, and I used 21 and 22. You can see just from this map that the branches aren't in those majority Black and Hispanic tracts, and neither are their originations. And so one of the things that if you read the case, you'll see is that, a lot of these institutions utilize their branches as sort of the center point of a lot of their sales strategies. And so if the branches aren't in those markets and a lot of the marketing and outreach strategies are being done around the branches, already you're going to have a disparity in terms of how well informed, how well educated, and how well an institution can serve the Black household or Black and Hispanic majority tracts. Another thing that this case talked about was that, even though 9% of the households in this market were Hispanic, there was no marketing materials were published in Spanish, and all the loan officers spoke only English. So there again, by having that type of strategy and by not, intentionally working to have outreach to the Black and Hispanic tracts and neighborhoods, that is what's leading to that 24 versus 5% penetration rate. So you can go to the.
We'll talk a little bit more, but I think, on the first two slides, one of the things that it appears to me is a really key takeaways for lenders, particularly on the IMB side, because obviously IMBs, independent mortgage banks, do not have per se retail bank branches, et cetera, is that as you look at the demographic makeup of your market, and when you see an opportunity where you are maybe lending in more of a heavily concentrated area in one area than you are in other areas in your marketplace, that may be the perfect opportunity to kind of take a step back and say, okay, how do we close this gap? How do we make sure through both what I call conventional and non-conventional marketing outreach, and we're going to talk a little bit about that later on here, guys. How do lenders need to pivot from selling to really storytelling and actually social marketing versus just day-to-day peer marketing that most institutions are traditionally used to doing. But the marketing aspect, I think, really stands out in the first two, and certainly as we transition, with Ocean Bank as well.
Can I just point out one thing while Laird, sorry, you were just talking about those high Black areas, census tracts. And I just want to point out that in these last few settlements, and consistent with all these DOJ settlements, it's really important to not just look at MMCTs, but also look at your peer compare ratios in those high Black, high Hispanic, high Asian census tracts, because your peer ratios could be so much worse in those high Black, the high census tracts. Majority minority in some of these cases, the peer compare ratio was like 3, even 2.5, which is not terrible. But when the agencies will hook on to those high Black, high Hispanic. So it's really important when you're looking at your data with your vendor, if you're using a vendor, that you also make sure you look at those areas with some focus.
Great, thank you.
Great point, Daniela, because from a strategy perspective, the differences between cultures are it's a pretty big difference in terms of what will work and what won't. So not doing that, and then not bifurcating the strategies appropriately, it kind of puts them in a terrible place. And you can see that in this particular case with Ocean First. Again, kind of the reason I brought these maps and this data into this PowerPoint was to show that this is something that's easy to see. Not necessarily easy to hear if you're talking census tracts, but when you look on a map and you can see the pink on this particular map are the majority minority census tracts, you can see where those are, and you can see where you're not. You have a problem, and I think that is where the data are so important in informing how you make sure you're not doing this. And, I think that Ocean First, when you read through that one, a lot of it was simply just not having a structure in place. So, the other ones I talked about branch placement, then there's, this sort of the sales and marketing strategy. From this complaint, it seemed like Ocean First just hadn't implemented strong fair lending oversight or policies. So that's another thing to think about. Even if you are, doing what you can internally to mitigate some of this risk, it's really important to have those policies and a method and a process of oversight in place.
Great.
So these are the slides. Those first three, obviously it's tough to look at the data and know that's happening, but this is the part that is exciting, and kind of how we transition our thinking from one of mitigating risk to capturing opportunity. So Tony mentioned about the multicultural market, and our firm does forecasting and analytics about mortgage opportunity. And as we look at the next 5 years, we're forecasting 2.8 trillion in purchase dollar opportunity, which is 31.2% of it. $2.8 trillion is what this multicultural market is really offering over the next 5 years. And what's interesting, and we'll talk about this in a minute, this is with status quo strategies. This is if nothing changes. That's a huge market. I'm going to go to the next slide.
Yeah, absolutely. I think, Larry, one thing I want every lender to walk away with is that when you think about mitigating risk, in my opinion, what we oftentimes talk to our lenders about and our partners is the best way to mitigate risk is actually to serve more. And by serving more, meaning serving more of your market, you're by default going to mitigate any risk or any foreseen perceptions that you are not trying to serve those markets. And so if I'm a sales leader, if I'm a compliance leader, if I'm a marketing executive, this is a powerful stat here to sit down and say to my team, look, in any given market across the country, there's a huge opportunity. For example, here in Orlando, Florida, $102 billion of opportunity. That is just a tremendous opportunity for us to look at and say, how do we get our fair share of the pie while also mitigating risk?
Monique, if you could go back to that slide, I do want to connect that with something that Daniela said. You'll also notice that some of those markets, there's that yellow shading, that's showing the top, I think it's top 10 markets for each borrower group. And you'll notice it's not the same. So one of the things that makes this complicated is that, markets aren't created equally in terms of, the distribution and who is the actual market. So for example, you can see in San Francisco, only, and this is loans, this is not household, but in this particular case, only 2.5% of that, opportunity is Black versus to Black borrowers, whereas 42%, of that opportunity is, forecasted to be to Asian households. But you can see that difference across the board. And if you look at someplace like, Atlanta and Dallas, there's a lot of opportunity in all three. So some of the markets have, 50, 60, a majority of the opportunity is coming from households of color. Why we aren't focusing on that from a business perspective is the big question. Okay, now you can go to the next slide, Tony.
This is one of my favorite slides coming up. Old school versus new school.
Me too. And so one of the things that we look at, we talk about why now. As we look at the opportunity, we could make the case and say, we're doing things to capture more opportunity. But the reality is that home ownership gap hasn't closed. It's only widened. And so something's not working. And when something doesn't work, we shouldn't keep doing the same thing. And so what we've been looking at and seeing with individual lenders is how, what are the common traits of lenders who are successfully working with more diverse households. And that's where I look at this old school and new school, kind of the dichotomy of that. And it's really going from that risk to opportunity perspective, being proactive instead of reactive. I mean, we all love the HMDA data, but waiting for the HMDA data isn't going to help you change your strategies, in place and, in real time. The role of diversity, there are many organizations where they have their general sales strategy, and then out here, on the peripheral is the strategy for households of color and diverse households. Why not have it be central? If your market is 60%, BIPOC, you're central to your strategy. And then moving the types of strategies, looking at that difference from market to market. You can't have a strategy that works for all borrower groups across all your markets. You need to be targeted. And, another piece of, what's successful, instead of looking at the data once and then creating a plan, the organizations that are successful are dynamic in how they're looking at this. They're interacting with and thinking about and changing strategies, in real time. They're not just saying, we're going to do what we do. They're saying, we're going to do this. We're going to see how it works. And then we're going to change. We're going to pivot. We're going to do those things. And then the last element of this paradigm is going from a way of what we call one-way communication. And that's not just communication, from the market to the lender or the lender to the market. It's communication between risk and sales and compliance and leadership. It's communication between different types of data. So past, present, and future. It's that really collaborative look across the board that is yielding, the best results. And, that 2.8 trillion, and this is what's so exciting about this, if we can change and start to close that home ownership gap, that 2.8 trillion becomes 4 trillion. And this is just the tip of the iceberg for the kind of, dollar opportunity that's out there. If as an industry, we can really learn how to work with the home buyers who really are the future of, of our country and our communities.
Laird, I also think it's important for everyone to take away, in my opinion, two nuggets. Whenever I give a little bit of advice, I call them nuggets. And the first nugget that I think is really important for every lender, every leader, every marketing exec to come to grasp with and realization is your customer of yesterday is not your customer of tomorrow or your customer of today for that matter. So I'll say that again. Your customer of yesterday is not your customer of tomorrow. How we've generated our business in the pandemic era and pre-pandemic was really more of the old school way of doing business. It was all about an originator. Who do they know? I know this agent, I know that agent, I know this person, this referral source, and that was really their source of business. Now that we're post-pandemic and also we're in a market where the entire opportunity or the majority of the opportunity, shall I say, is really built around those consumers who, one, do not have a mortgage, but two, do not have a mortgage and don't know that they can qualify for a mortgage or actually could be owning today versus renting. The challenge is making the pivot from selling to storytelling and moving to what I call social selling. And one of the greatest things that I try to help lenders understand is we do not have enough minority LOs to do all of this business. I'll say that again. There are not enough minority LOs for every organization to have to serve these markets. So what that means is your non-minority LOs are going to have to understand cultural competency. They're going to have to understand cultural nuances on how do I serve, how do I engage, how do I communicate with this multicultural market, recognizing that each of those cohorts are different. And when you can do that, you are going to win, 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 and you will help your loan officers succeed, succeed, succeed. And that's where most lenders right now, they're not pivoting to a model where they're understanding that what got me here won't get me there, because the whole dynamic of the consumer model has changed. And last case in point, this past weekend, the UFC fight was broadcast on Netflix versus mainstream TV. What does that say, guys, about the future, where we're headed? It's really simple. The average multicultural millennial and the average millennial spends 3 to 6 hours or more on social platforms, YouTube, Instagram, Facebook, TikTok. If you are not moving there as an organization, you're going to do your originators a disservice, as well as you're going to miss out on one of the largest market buying opportunities in the future in terms of potential homeowners, because they're pivoting from print, they're pivoting from radio, they're pivoting from even being seen in the local market to social.
Add to that, one of the things that's so great about opportunity is that opportunity goes well with empowerment language. And it's empowering when you're talking about wanting to and getting to work with a household group versus having to work with a household group. That entire mind shift change has ramifications beyond just, thinking about what the dollars are going to be. It's that whole shifting your mindset.
Right. Absolutely. I agree. So we're going to pause real quick and actually kind of have a little dialogue. And then Larry, we'll come back in and take a look at a couple more charts and then really end up talking about best practices. Danielle, I'm going to start with you. You and your firm, you guys are really subject matter experts, in my opinion, in this market. And so have you noticed any trends that are developing from the most recent guideline settlements we reviewed earlier that, are anomalies, or maybe that might be, something that lenders need to be cautious and aware of?
Yeah, so I think the first thing to kind of just pick up on is Fairway is the second IMB in history that has gotten one of these redlining settlements so far, right? But we can expect a lot more in that area because, especially like you were just talking about, Tony, the business model for IMBs is oftentimes to really lean on those realtor partners, right? If you're leaning on realtor partners for referrals, you're likely to have a very similar fact pattern to, what we see in Fairway, right? Especially if you're national, you're going to end up in some geography where your realtors are targeting high income markets. And so it could easily create a disparity. It's not like the fact pattern is so out of whack or so egregious, right? So I think one thing I just want to note is like this could really impact, especially when we're talking about in the IMB world, like any of the IMBs. I can think of a lot of different clients that if you're not really like monitoring your data, you could easily fall into this trap for enforcement. The other thing is do something with your results. So doing your annual, redlining testing is great, but if you're not actually doing something with those results, it's going to hurt you down the road, right? Like the trend in the last 3 big settlements is that there was some form of what the agencies would call reckless conduct because management knew about redlining risk, either through an audit or through, from a third party or actually through like an agency audit, and did nothing with it for several years, sometimes not until the investigation began. Another thing to focus on is thinking about your branch closing and branch opening strategies and involving sales to give you that intel. It was specifically noted in one of the settlements recently that the company didn't have a branch written program, right? And a lot of mortgage companies that I work with don't, because it's really about production and metrics as to whether or not they open or close a branch. But the reality is that that's something that needs to be monitored, not just from a production perspective, right? Which, but also from a redlining risk perspective. Because if you open a really, if you have a really big producer that comes in and opens a branch in Houston in a high income area, that MSA is, has a ton of majority minority census tract opportunity there. And so your compare ratios are going to look different. It could inadvertently create a redlining issue for you. So really make sure that sales is involved in your redlining kind of mitigation program and that they're informing you of what's going on with, branch and hiring and all of that, because it impacts redlining and you need to be aware of that. And that's something that's come up not just in these settlements, but it's come up in the context of exams that we've worked on, targeted redlining exams for lenders. And the last thing that I'll note is LEP. So again, this comes up not just in the settlements, right? Limited English proficiency borrowers. It doesn't just come up in the settlements, it comes up in every LO interview. If you ever get a redlining exam, they're going to ask your LOs what resources the company provides for limited English proficiency borrowers. And so if you are in an area that, part of the issue with getting minority applicants is that, there's a high Hispanic population, like in the South Side of Chicago or something like that, and you're not thinking about implementing a language access program, it's really something to start considering. I think the expectation coming from the agencies is that you're doing something about that. And that means having the resources all the way through at least the origination of the loan, the employees that can actually work with the borrowers in those languages. So I think that's an area that's going to get a lot more attention in the future.
No, all great insights. One thing that I'll add to that, Daniela, that I see, and I'm kind of on this journey right now. It might even be a soapbox to a certain extent. But when you look at the, again, really not even the last 3, but you take a culmination of all the 23 and 24 DOJ settlements. Marketing has a chance to become a hero now. If you're a compliance executive and you're on the call today, go to your chief marketing officer and say, hey, we've got to figure out a way to actually increase our social engagement and our social outreach to that multicultural market to really help mitigate our risk. Secondly, if you are a chief marketing officer, understand, I believe one of the most important things that lenders can do today is equip the sales team as well as equip the brand by utilizing social engagement, AKA we call it social selling here at NAMMBA, in terms of putting out education content. I've never seen an organization pay $2 million for marketing outreach when they've actually demonstrated that they were trying to engage, educate, and help inform the consumers in those impacted areas. And so I think it's really important that from a marketing perspective, you get a chance, I think, as we move forward, to actually contribute to the business in a very impactful way, both on the risk side, reducing fines, but more so helping to generate leads by really helping to make a pivot from how originators are originating today in terms of how they are actually, how they can engage and build trust and educate the consumers of today, who are vastly different in terms of how they want to attract and get that knowledge. Danielle, we talked about the last three, but also more recently, there was a settlement that came up that wasn't redlining per se, but it was a case with the CFPB and an IMB, Townstone. And all those, kind of settled a little bit quietly, nothing major, no big fanfare. Can you just kind of tell us what impact does that Townstone settlement have on the future redlining cases?
Yeah, so actually that's the most recent redlining settlement is Townstone, because it's the proposed settlement actually was filed on November 1st. But it hasn't gotten a lot of press, you're right. And I think part of the reason for that is that we've been hearing about Townstone for years. So just as a reminder, for those on the call, the CFPB sued Townstone in 2020 for allegedly redlining in the Chicago CBSA. And it went to court. So, this went through the court system. It's just the CFPB, not the DOJ, involved in this one. And the federal court in 2023 actually sided with Townstone and dismissed the case. The case was then appealed to the Court of Appeals in the Seventh Circuit. And just this summer in July, they sided with the CFPB and overturned the decision, saying that the CFPB was right and that ACOA applies to prospective applicants. Again, just the CFPB, not the DOJ, so this doesn't impact other DOJ reviews, because the DOJ has jurisdiction over not just ACOA, but also the Fair Housing Act. But in this case, I think what this does is, number one, it obviously creates precedent in the Seventh Circuit. But only in the Seventh Circuit, right? So to some extent, there could be some forum shopping. It really kind of depends on where your matter is and what judges and, what court you're in, what circuit you're in, as to if you're dealing with litigation on a redlining matter. The more practical reality is that I think it emboldens the CFPB because ACOA applies to prospective applicants, and that's sort of like the gist of all of these redlining cases, right, is prospective applicants, not actual applicants. It's what are you doing to encourage or discourage prospective applicants? I think it's really interesting, especially for the CFPB, to kind of further embolden the fact that they may seek redlining enforcement, if not in this next administration, which we can talk about for a little bit after this, definitely in the future, is the fact that this court decided for the CFPB's interpretation of ACOA, even after in July, the Supreme Court said the Supreme Court decided a case that was hugely impactful to agency deference on ambiguous regulations. And the Supreme Court essentially said in July that we're not going to defer to the agency's interpretation of a rule if it's vague. And even right after that, 2 weeks after that, the Seventh Circuit court decided to side with the CFPB on their interpretation, right? So essentially what we see is courts are going to decide, they might decide for the CFPB, right? In this case, they certainly did. Unfortunately, that's not great for lenders. But I think what it's going to do is it gives some precedent for the CFPB to continue to seek enforcement in the redlining space.
And Daniela, on that note, if I'm an IMB or even to a certain extent, maybe a small regional community bank, do the risk of me go up higher based on this Thompson settlement that potentially we could face an audit or a regulatory review from the CFPB around redlining?
I think you were already kind of at that risk, but I think what it impacts is what's going to happen if you don't settle with the CFPB, right? And you end up going to court. A lot of these things settle because people are afraid to litigate against the government, which makes sense. But in this case, I think the risk of the government at least having an opportunity to prevail is a bit higher, right? Again, it's only precedent in the Seventh Circuit, but I think it's possible that the CFPB is emboldened to continue to litigate cases like this as opposed to settle.
No, great question. And one of the things I'm thinking about when you said that, it just made me go to a little plug here for NAMMBA, but part of the reason why we developed our ASIL, our Accredited Social Impact Lender Certification, was we wanted to help lenders have a hedge in their regulatory review to demonstrate to the regulators, here's what we're doing. We already know where we are, or we've self-identified, or we've partnered with the industry's social impact lender, and we have a game plan. We have a playbook. We're not perfect, but here's where we're trying to implement those. And I think when we talk to the regulators and when we talk to other litigators, the ability to demonstrate that you are being proactive versus reactive, as Larry talked about in the old school versus new school, that goes a very, very long way, particularly when you start getting into the monetary fine piece of how much you're doing. Would you say that as well, Daniela, based on your?
Yeah, you don't want to start implementing your sort of redlining program when you're in the middle of an investigation or an exam, right? You want to show that you've been making efforts in that regard for quite a while.
We're gonna speed up here, but speaking of November, you mentioned Townstone just came out in November. Also this month, we had an election. There's going to be a new change in administration. What do you think with the new administration? Is there, the impact to redlining initiative and enforcement? Is this like the last webinar we'll ever have and we don't have to worry about it? I always say, at the end of the day, it's easy to, get a redlining. All you got to do is just don't lend. And so from that standpoint, what do you think we're heading, Daniela?
Yeah, so I think the first takeaway is this topic is not going away. I'll tell you what to expect, I think, in the next few months. The agencies are trying to push forward whatever's in their pipeline. And I can tell you from personal experience, there are a lot of investigations pending right now. So in the next few months, I think you can expect to see settlements. I think you can expect to see them potentially filing complaints, because the new administration doesn't take over until January, right? And right before then, they have an opportunity in the next couple months to really push forward some more activity in this space. And it's their last chance potentially for a while, at least when it comes to enforcement. So that's the first thing. The other thing I think that is an important takeaway is I don't think there's going to be any rulemaking related to redlining, which frankly is a little bit unfortunate from the federal side, because when I talk to a lot of lenders, particularly ones that aren't subject to the Community Reinvestment Act, so non-banks, they tell me that they would like to have some clear rules, right? They would like to have some actual expectations, as opposed to being told when they're slapped with an investigation or a settlement that they did something wrong. And so I don't think there will be any rulemaking in this space. I think what's going to happen in terms of enforcement and investigations is they're likely to slow down a bit over the course of the next administration. At least that's what we saw with the last Trump administration. But importantly, exams will continue. And there will be targeted redlining exams, just like there were during the last Trump administration. And those exams are really critical, because even if you come out with no matters requiring attention, even if you come out with no adverse findings, any recommendations can and will be used against you when the new administration takes over. We saw that actually in the last round of the Trump administration is there were exams for redlining. Some of our clients had gotten through those exams completely fine. And then the Biden administration took over, there was a change. They had another exam and they brought in enforcement because they claimed that there were repeat findings, even though in that last exam, they had no matters requiring attention. So examinations are going to continue, and you have to be really careful when you're going through those exams, because even if it looks like everything is okay, it could really come back to hurt you down the road. The other thing I think that's really important to talk about is states. We again saw this in the last Trump administration. States become way more active in the space when the federal government does not. They pick up the slack in some ways, and they've already started doing that. So the New Jersey Attorney General just had a redlining case against a bank for violating New Jersey fair lending or discrimination laws. So states are getting into this, and actually some of them are coming up with their own Community Reinvestment Act requirements, like Illinois is the most recent one. So just, you're still, especially if you're an IMB, you're going to be subject to the states. Even if you're a bank, depending on what type of bank you are, you might be subject to state regulators on this. And I think they'll become more active as well.
Yeah, I'm seeing a lot of requests and, calls from Illinois and New Jersey area as well with the state regulators. And so, just beware. I was joking with Daniela before we came on board. I was like, hey, I'm going to be like the attorneys. We got to have a jingle for NAMMBA. You get a lawsuit or you get an MRA, call 1-800-NAMMBA. And hopefully you'll call before you get that. But if not, we're there when you need us. And so we're going to work on a jingle here, because it sounds like this is not going to stop anytime soon. And so we've got, Danielle, thank you. We're going to come back here in a few minutes and get a couple more insights. We got about 13 more minutes left. And so let's talk about, Laird, how to leverage data. We want to kind of go through these next couple slides so that we can really end around best practices and take some Q&A as well.
Think back to that new paradigm, the old school, new school. And I think the most important thing to think about is that it's important for data to be dynamic and collaborative and comprehensive. And so before I get into the why, I want to talk about the what. And so one of the things that I like to use as an example is, data needs to be past, present, and future. Because when you're making these strategies, you're running a marathon and having a sprint at the same time. And so just like us, markets are, they're impacted today. Who they are today is influenced by their history, and what's happening tomorrow, what's happening tomorrow is also influencing what's happening today. So you really have to be very comprehensive and have a 360-degree view of what's going on, and also comprehensive. And you can see a slide in a minute about all the different factors and different pieces of data you have to bring together. But because of that, why do we need that? Because we need to learn to use data through the whole life cycle. So obviously, I think we've thought a lot, and we know that data is used in these cases, for the filings against the lenders. But the data needs to be used early on. Who and where are the communities we want and need to serve? Data, the census data, it's so actually easy to get really good data on the people and the communities that you're working with, and to know more about them. A piece of data that we forget about is, qualitative data that you get from organizations in the communities. That can tell you a lot about who they are, where they are, and what they need. So then that's one piece. So that's sort of figuring out how to, identifying who your markets are. And then the data can be used to identify which strategies you need. One thing I want to encourage everyone when they're thinking about strategy is to be innovative. To Daniela's point, if you're trying, it's better to be trying and try different things. And if it doesn't work, turn to a new path, because it's through that kind of experimentation and trial and error that we're going to find sort of that new way. And then The other piece that I think, again, has to be done not just when there's a complaint filed, but that constant cycle of identifying, building, doing, and then evaluating. Are what we're doing, are the things that we're doing working? Are there people and communities that we're missing or hurting? And are there people in communities that this is working really well for? Knowing that is sort of that dynamic interaction that we're talking about, and that switch from old school to new school.
Great. We're gonna go through, Ashley, we're gonna, if it's okay, slip these slides and talk about really keys for success. We got about 10 minutes here. And so I do want to have a few minutes for those who have a couple of questions. Please send those through the Q&A. We would love to have some interaction dialogue, get the perspectives of the panelists as well. So just send those again through the Q&A. And we're going to save a couple of minutes. But Laird, 5 things that leaders can do to mitigate risk. And also, Daniela, we'll get your opinion on this as well.
Yes, I think this is sort of a recap of what we've been talking about. This isn't about mitigating risk. Future consumers and households, that's not risk. Those are people. That's opportunity for home ownership and opportunity for dollars. So change your thinking. And if you do that and you start thinking about opportunities, you by default start to appropriately and truly start to serve the markets that you're looking at. You're not going to be wrong if you're focused on the opportunity in your market. And that's really that, where, who, and how. Think about who it is, where they are, and how are you going to work with them. Words and content matter. I know Tony will talk about that. The way you communicate with people, whether it's different language, different different speech patterns, just different ways of describing issues matter. And it's sort of in our role as in the industry as lenders, we need to be thinking about how people need to be communicated with, as opposed to expecting them to communicate the way that we do. Part of that is, always be evaluating and adapting what you're doing. Are you challenging, current biases? Are you looking at this, what you've been doing and seeing the data and deciding whether it's working? And then the last piece is that, one of my favorite quotes is, it says, strategy without execution is pointless, and execution without strategy is aimless. And so think about your strategy and what you can do, how you can execute it with data and all those other pieces of the new school way of thinking. If you do those things, there's success is going to happen. It's not overnight, but I think you'll be on the right path.
Daniela, what are your thoughts in terms of takeaways a little bit for lenders on how to avoid redlining?
I'll give you my number one recommendation is somebody has to be in charge and somebody has to be monitoring your community lending program at least monthly. And the biggest issue you'll see in every consent order, almost every consent order, you need to assign a community lending leader or officer, right? The reason for that is because there has to be management of this. Like everything we've been talking about, I think Laird, Tony, you both talked about the fact that it might be different in every community, right? And the communities that you're at redlining risk for could change year to year, depending on your data and whether or not you open a branch. So it's something that needs to be dynamic monitoring. And that just means you need to have really strong oversight. You need to have a committee of people with one person leading it and one person accountable, right? Whether that's somebody in-house or somebody outsourced, frankly, it doesn't matter as long as there's someone that's keeping your team accountable. And you have to involve sales, because everything is driven by sales and they need to be aware of the products. They need to have input on what's selling, what's not. They need to be involved in the recruiting process, how they market, right? So I would say just really have centralized leadership surrounding this and someone that's accountable, because there's so many moving pieces and they change every month, and you need to document what you're doing and what you're changing every month in order to, essentially prove that you're compliant to the agencies when they come in.
Great, great. Well, let's talk, guys. I'm going to pull up real quick. One of the things I'll close out on, and I want to ask a couple of questions here that I think came through the Q&A. Every lender is going to have to adapt their business model if they really want to grow and ultimately be successful. I've said on record, I think as an industry over the next 3 to 5 years, we're going to lose 200,000 loan officers or more. We have about 680,000 licensed, about 181,000 of those on any given day are for IMBs or non-banks. But if you think about the ability for originators to pivot how they develop their business from pre and post pandemic to today, you're going to have to help your originators in your organization pivot to what we call social selling and connecting and educating the consumer more. And so a couple key takeaways: understand the customer of yesterday is different than the customer of today. You got to pivot from selling rates, selling products, programs, closing costs, to really today's consumers want education content. Last but not least, you need to look at your marketing and your marketing outreach strategies and understand that you have to look at those differently in order to really serve more people. So let's get into a couple of questions. Again, if you have a question, guys, send it through the Q&A. Daniela, there's a question for you. You mentioned that there was an example of an entity who had a redlining exam during the Trump administration with no issues, and then they got no MRA, but then subsequent to the Biden administration, they had an enforcement order. How did the CFPB determine that they were repeat violators prior to, if they didn't have an MRA?
They had an investigation, to be clear, after the Trump administration. We don't know whether or not it's going to end up in an order or not yet, to be determined. But what I was talking about is, okay, so every report, you're going to get a supervisory recommendation letter after a redlining exam. There's going to be supervisory recommendations in that letter, regardless of whether or not they're elevated to an MRA or not, right? And those recommendations, they expect that you act on them. Even if it's not like an MRA where you have to act on them within 90 days, they expect you to act on them and take them seriously, because basically the government's telling you, you could improve in these areas. By the time you get to your next redlining exam under a different administration, if you have not acted on those supervisory recommendations, they're going to say, they're going to refer you to enforcement. They might not feel confident enough to put them in as MRAs, unfortunately, under the Trump administration, as they would under another administration, but there's still supervisory recommendations that you will be held accountable for at the next exam, especially if it's a different administration that is really pushing redlining initiatives. So that's what I meant by repeat findings. They're not repeat MRAs, but they will consider them as repeat issues that have not been addressed.
Great, great. 3 minutes left. I think we got time for one more. Laird, what would be parting advice, as I put up a slide, if people want to contact you, but what's a parting advice that you would be sharing with everyone on the call today?
Good point about accountability. And I think that's, in terms of the managing the fair lending program and oversight. The other thing, though, about leadership, I think having, leadership standing behind multicultural lending and looking at this as an opportunity is critical. The lenders that are doing a great job have leaders who have committed to this, who've committed to, closing the gap, and they're seeing that result, not just in the fact that they have less risk, but in their production numbers. So I think that leadership's important. And obviously, I think data is really important all along the way.
Great, great. As we close out here, it looks like we got one more question. If not here, Danielle, any additional parting thoughts on your end? And then I'll close this out.
Sure. I mean, it goes back to Laird, really, which is know your data. I mean, at this point, there is an 100% proactive requirement from the agencies to know what your data looks like, because they know what it looks like, right? So that's the very first step. And if you have, if nothing else, you get your data, and then you can start talking about solutions, and management will help you with that. Great,
great. Well, first of all, as we close out, I want to thank everybody for joining. My parting comments really is really simple. I think right now is a huge moment of opportunity for every lender, whether you're a bank, a credit union, an IMB, non-depository. There's a huge opportunity for you to do good by doing good. And really, at the end of the day, there's an opportunity to help your originators grow their business, grow their income, and most importantly, grow their impact to the communities that they serve. And so for us at NAMMBA, we like to say that by, increasing your outreach, you decrease your opportunity and you mitigate your risk. And if you can walk away for 2025 saying, what do we need to do to increase our outreach and mitigate our risk by serving the multicultural market, you will have an opportunity to significantly grow your business, significantly impact communities that you do business in. And last but not least, certainly mitigate your risk in a regulatory review. And so we want to thank everybody for joining us. If you want to learn more about our ASIL program, our accredited social impact lender, we would love to share more information. Just scan and connect with me on LinkedIn, send me a shout out, and let me know what you're looking for and what you would like to see in our next webinar as well. And last but not least, a big shout out and thank you to HousingWire for their commitment to social impact lending as well. This concludes our webinar, guys. We're out of here, man. Headed to Starbucks to grab a cup of coffee. And we see you on our next NAMMBA webinar. And thanks again for joining us today. Have a great day.
Have a great day, everyone.